Hello everyone, good morning. Today we will see about the discuss the topic of the insurance. Here is the includes chapter 3 and there is the introduction to risk management. So let's start. Insurance. Commercial insurance is also used in a risk management program. Insurance is appropriate for loss exposures that have a low probability of loss, but the severity of loss is high. If the risk manager uses insurance to trade certain loss exposures, five key areas must be emphasized. That is, has five key features. So let's see. Selection. The number one of is the selection of insurance coverages. Number two is selection of an insurer. Number three is a negotiation of terms. Number four is a dissemination of information on concerning insurance coverage. Number five, the periodic review of the program. So this is the five key features of this insurance. The first, the risk manager must select the insurance coverage needed to cover a selected must be appropriate for ensuring the major loss exposures identified in step 1. To determine the coverages needed, the risk manager must have a specialized knowledge of commercial priority and liability insurance contracts. Commercial insurance is discussed in chapter 25 to 27. The risk manager must also determine if a deductible is needed and the size of the deductible. A deductible is a provision by which a specified amount is subtracted from the loss payment otherwise payable to the insured. A deductible is used to eliminate a small claim and the administrative expense of adjusting these claims as a result. Substantial premium savings are possible. In essence, a deductible is a form of risk retention. Most risk management programs combine the retention technique discussed earlier with commercial insurance. In determining the size of the deductible, the firm may decide to retain only relatively small part of the maximum possible loss. The insurer normally adjusts any claim and only losses in the deductible are paid. So here is the some of the summary of this insurance. So I will do skip because when student read this, you should cover this all of this summary of this texts. So I just show you the some preview of this part of this summary. The basis of this the approach of the purchase access insurance. So there is the main key. The main key feature is this. For example, a retention limit of $1 million may be established for a single file loss to planned value at $25 million. The $1 million, it will be $1 million would be viewed as the maximum probable loss, the unlikely event of the total loss. The firm would absorb the first $1 million of loss and the commercial insurer would pay the remaining $24 million. So that is the basis of this summary. So when you buy this book, you should read this perfectly step by step so that you can understand. Hopefully it will be very helpful for you because it is the basic of this book to become pro, to gain knowledge about the risk management of this insurance. Introduction of these books. Here there is the principle of risk management and insurance. So we will go to the next summary of this part of the topic. Here we see they have advantages and disadvantages. So let's start. Advantages. The use of commercial insurance risk management program has certain advantages. The firm will be indemnified after a loss occurs. The firm can continue to operate and may experience a later on or no fluctuation in earning. Uncertainty is reduced, which permits the firm to lengthen its planning horizon or to fear are reduced for the managers and employees, which should improve performance and productivity. Insurers can provide valuable risk management services such as loss control, service loss exposures analysis, and claim adjusting. Insurance premiums are income tax deductible as a business expense. Here is the disadvantage of insurance. The use of insurance also entails certain disadvantages and costs. The payment of premiums is a major cost because the premium consists of a component to pay losses, an amount for expenses, and an allowances for the profit and contingents. There is also an opportunity cost under the retention technique discussed earlier. The premium could be invested or used in the business until needed to pay claims. If insurance is used, premiums must be paid in advance and the opportunity to use the fund is forgone. Considerable time and effort must be spent in negotiation. The insurance covers an insurer and insurers must be selected policy terms and premiums must be negotiated. And the firms must be cooperative with the close counsel activities of the insurer. The risk manager may have a risk incentive to follow a loss control program because the insurer will pay the claim if a loss occurs, such like toward loss control and could increase the number of non-insured losses as well. So we already discussed about the advantages and disadvantages of this insurance. So now this topic is the name, which method should be used. In the determining the appropriate method of handling losses, a matrix can use the classifies the various loss exposures according to the frequency and severity. This matrix can be useful in determining which risk management method should be used. That is the exhibition exhibit 3.3. We already have discussed. The first loss exposures is characteristics by the both low frequency and low severity of loss. One example of this type of exposures should be the potential theft of office supplies. This type of exposures can handle by detention because the loss occurs infrequently, and when it does occur, it seldom causes financial harm. So here is the method should be used. It has briefly explained. So when you read this book, you should read this. Here is the risk management matrix. So today's topic is in today. Take care everyone. See you tomorrow.